Joining me first on the show today is Mr. Sudhir Pai, CEO at Magicbricks, to help our viewers understand how to take that first step when investing in real estate, some essential do's and don'ts, and also how to gauge the correct real estate investment for you, and much more. So let's get started with that conversation. Mr. Sudhir, thank you so much for joining me on the show. What would you say is the first step for someone looking to invest in real estate for the first time, and how do they go about the process of making a purchase?
You are likely to make what is going to be the most important or one of the most important financial decisions of your life. So it first pays to build conviction into why you're buying a house. Now, there are, of course, many reasons for wanting to buy a property. There's economic security. You might want to build a lifestyle around it. You might have an investment objective. But one must be able to answer the question for yourself on what is the reason why you're looking to buy a house and build a high degree of conviction behind it. Second step, determine your requirement. Now, there are 4 parameters that are essential to make a basic requirement. First, what can you afford? What's your budget? Second, which part of the city do you really want to live in? Third, how big a house do you want? And fourth, when do you want the house? Do you want something which is ready to move in, or can you wait for a few years while you get possession? Now, be mindful that these 4 parameters, one will have to make trade-offs. For example, if you want a big house, but you're constrained on budget, you might have to compromise a bit on distance. Or if you want a property which has the latest amenities, then you might have to wait a few years to get possession, right? So basis what, and if you don't know where to find information or how to decide on what your budget is or which part of the city to stay, there's a lot of help available online. Portals like us, for example, carry a lot of tools and calculators that can help you decide how much you can afford basis your income and basis what your current outstandings are. There are tools available which give you locality reviews, pros and cons of one locality versus another. There are distance calculators which can tell you the optimal distance between the point of interest that you have in mind versus the locality where you want to stay. So there's a lot of online help available that can help you research and get the answers to what your requirement is. Third, I think you should make a list of what are non-negotiables for yourself and what are good to haves.
Okay, well, point taken. Thanks so much for that, Mr. Pai, but also help our viewers understand that when it comes to choosing between different real estate assets, like so you have land plots, apartments, ready to move in apartments or under construction apartments, how should a new investor make that decision of which real estate investment is fit for him or her, and what are the pros and cons of each of these avenues?
If you're an investor and considering between should I buy a land, a plot, a house, or maybe an apartment, first of all, start by defining your investment objectives, right? So how much is the return you want? What is your time frame? And what is the amount of capital that you want to invest at this point of time? I think the second thing that you should pay attention to is how much is the time and your own capability from a point of view of the amount of effort you want to take in the process of buying the particular asset and exiting that property. Second, how much is the time and effort you want to put in overseeing the property and in taking care of its maintenance? Now, if you club these 2 things, which is what are your investment objectives versus the amount of effort and capability and resources you'll have to put in overseeing the entire asset, I think you will get most of your answers. For example, from a return perspective, assuming that everything else remains the same and you're bought correctly, plots are likely to give relatively better returns as compared to a house, which is likely to give you a marginally better return as compared to an apartment. But from the second point that I mentioned, buying a plot is likely to take more effort, unless, of course, you're buying from a very reputed developer in a gated community. But otherwise, it's going to take far more effort in terms of paperwork, you're doing legal checks, most plots are outside the city, so the sheer amount of effort at going and evaluating the property is going to be far more. And you're going to face this both at the time of buying the plot as well as at the time of exit. Likewise, from a point of view of maintenance or overseeing the property, plots or independent houses are going to be far more, it's going to take a lot more effort as compared to the effort that an apartment is going to take. So if you're someone who doesn't want to put too much effort in the process of buying or exiting a property, and you don't want too much headache at maintenance or oversight of the property, probably buying from a good developer in a gated community could be a good answer.
Okay, well, point taken, but also help our viewers understand what are some common pitfalls that first-time real estate investors fall into usually, and how can they avoid them?
I think an important thing is not to fall for the first shiny new toy that comes in the process of buying a house, right? So real estate, by its very nature, it's a pretty glamorous industry. You're likely to come across very good-looking collaterals, even better experience centers, a lot of lovely advertising material. Not that there's anything wrong with it. In fact, any good developer or any good project is going to project itself very well. But I think you have to train your mind and yourself to be able to look beyond that and determine the real substance of the property that you're looking to buy. So that's, I think, rule number one, which is don't fall for the first shiny new toy that comes along. I think the second thing is don't fall for a herd mentality, particularly in today's market. Don't rush to buy a particular project or a property just because everybody else is buying it. It may not be right for you. Third, I think you have to plan for an exit, especially if you're an investor. Then by definition, you're not going to stay invested forever. At some point, you'll seek to exit that particular property. Plan for that exit beforehand. A lot of investors don't plan for exit, and at the time of exit, they would then face difficulties. And last but not the least, pay careful attention to the fine print. Do check if there are any clauses that make exiting the property difficult for you, or if there are any fees or charges that you were not aware of, right? So do go through the fine print and make sure that things are okay for you. I think if you take care of these 3 or 4 elements, you should do quite okay.
Okay, now that we've understood how to buy, help us understand if it is possible to time this entire real estate market. How should a beginner analyze market trends to determine the right time to buy? Is there a right time to invest? And what are some key economic indicators to watch out for in real estate for someone who's looking to dip their toes in this real estate investment?
I think it's not a I think you shouldn't enter real estate with a very short term in mind.
Okay.
I mean, for example, the last 3 years have been excellent for real estate. But even so, even though the markets are looking very strong, we usually advise buyers don't take a short term view. So if it's a quick buck that one is seeking to make, then we'd usually advise people to stay away. Now, a lot of the work that Magicbricks has done has been to help a first-time buyer or a first-time investor go about making his decision through a data-driven method. Now, our framework usually has revolved on the following. Right now, if you look at the real estate markets, there's plenty of data available on how prices are moving and what the sales velocity looks like. Now, that's the output. But if you're going to deconstruct it into determining what drives price or what drives better sales, then the following factors is what one will need to look at. We usually look at demand-supply mismatches because a locality in which there is strong demand and limited supply is likely to see prices hardening. We look at yields. A project, a property, or a locality which has high yields is likely to do better from future price appreciation. We look at sentiment in the market, right? And these are some of the parameters which I think there is plenty of data available. There's a lot of research reports available. I think as a first-time buyer or investor, if you familiarize yourself with all of these parameters, you should be able to draw a pretty good assessment into which way the wind is blowing and take a smart data-driven decision for yourself.
Okay. But Mr. Pai, you did speak about yields, and that is something that I want to base my next question for you on. For someone considering investing in an apartment, how should they evaluate the rental yield that they're expecting? What's a good rental yield to aim for? And even if they're not taking it to rent, they're taking it to reside in that apartment, what's a good return rate that they should be expecting in the future when they make a sale? And overall, just what would be an ideal, a good rental yield to aim for?
First of all, let's define what yield is. Yield is actually your annual rental less the maintenance costs divided by the current capital value of the property.
Okay.
For example, if you own an apartment which the market price is about 1 crore today, and if your monthly rental is 25,000 less the maintenance fees, your annual rental is going to be 3 lakh rupees. So 3 lakh rupees divided by 1 crore, your current rental yield becomes 3%. That's the way yield is computed. Now, why is yield important? Yield is important because it is a good indicator of what is the underlying genuine demand for houses in that particular pocket, right? So if you're not planning to stay yourself and you're planning to give it up for rent, then a yield is a good indicator of how much that property is in demand. Because if there are a lot of people seeking to take the property on rent, your yield is likely to be higher. If not, it's likely to be lower. Now, Indian markets have typically delivered a yield of about 2.5% to 3%. At this point of time, markets are on a much stronger wicket. There are cities where the yield is going all the way up to 4%. But generally, we would reckon that a yield of anything upwards of 2.5% is a good yield to have. Now, one should be worried if the yield of a property is lower than 1%, or maybe even lower than 1.5%, because then you should evaluate it a little more stringently to make sure that you're not buying a property where the prices are inflated or the particular market is not very frothy. So I think that's the way to look at yield. But please also bear in mind, yield is like the dividend returns of an equity scrip, right? So over the long term, if real estate is going to deliver a 10 or 11% return for you, then 7 to 8% of that return is going to come from capital gains, and maybe 2 to 3% is going to come out of the rental yields. So do bear in mind that while yield is important for the reasons that I just mentioned, the larger return is going to come from capital gains.
All right, Mr. Pai, thank you so much for joining us on the show on ET Now and explaining our viewers how they can get started with their real estate investment journey. On that note, we'll let you go.